It's not like any other podcast, coming to you straight from the heartland, where investing is told like it is. It's time for Darin Garman's Paranoid Banker Podcast. Hold on, because here comes the next episode of the Paranoid Banker Podcast.
All right, so hey there everybody, Darin Garman here, and we're going to cover in this week's podcast the most common questions I've gotten regarding the Heartland Investment Flagship Fund. As many of you know, the fund is going to be wrapping up here pretty soon, and it always goes this way with investments like this. When we start getting towards the end of being able to get involved in it is when most of the activity, most of the questions come. And let's face it, including me, we're all procrastinators, and I'm in that group too. And so, not surprisingly, I get most of my questions, most of my activity, most of the inquiries, just most everything regarding our flagship fund, and it usually happens within the last 3 weeks of it being available to investors. And so what I thought I would do with this podcast is really, I think, save you some time and give you some more information, because what I've got here is I've got emails from investors like yourself, and really I've condensed them down to the top 6-7 questions I get from investors regarding the flagship fund and regarding getting involved with us here in the Heartland and getting involved with Paranoid Banker investing, especially when it comes to apartments. So let's just jump into the top 7 or 8 questions, shall we? Let's do it. And I know that we're going to cover something that you've been thinking about, something that you just probably either haven't gotten around to asking me, maybe forgot about asking me, or maybe it's just something that's been in the back of your mind and you just kind of wondered about. I know we'll probably cover those. So let's go ahead and let's just jump in. Okay, this email here is from Kathy Hale. I think I pronounced that right, Kathy Hale. And Kathy asks, Darin, what is the minimum investment in the fund, and can I invest IRA or 401k money? And she specifically talks about a Roth IRA. Well, Kathy, that's really 2 questions, but I guess I'll handle them. First of all, the minimum is $50,000. To invest in the flagship fund. It's $50,000, and yes, you can invest IRA or 401k, Roth IRA money, the self-employed pension money, SEP money as well. Now, the interesting thing is not a lot of people know they can do this. I'm a little surprised that many don't know they can invest IRA or 401k monies in real estate. Directly in real estate, you can. And it's actually pretty easy to do. Many of our partners do this. Actually, hundreds of our partners do this. And you get all those tax-deferred benefits of owning great real estate properties because they're in your IRA. So yeah, the minimum is $50,000. And yes, you can invest IRA or 401k money. If you want information on how to do that, how to get started, how to get the ball rolling, just contact my office. We'll go ahead and we'll get you that information. We will point you in the right direction on who to talk to, who to get accounts set up with, who is really good at this, how to get the most for your time, effort, energy, and any money you may spend setting it up. But I can tell you it's well worth doing it. And by the way, even if you don't do it for the fund now, having it set up for the next time you have an opportunity to get involved in a property is definitely worth it. I personally have my own 401k money in the fund too. So I'm not just telling you that because I think it's a good idea. I personally have skin in the game and have my own 401k money in the fund as well. So minimum is $50,000. Yes, you can invest your IRA or 401k. If you're not quite sure how to do that, no problem. Contact my office and we can get you the information you need in order to get the ball rolling. It's actually pretty easy to do. Okay? All right. This next question comes from Blake Hansen. Blake Hansen. And Blake asks, Do I need to be an accredited investor, and what does accredited mean? Good question, Blake. The answer is yes, you do need to be an accredited investor in order to invest in the Heartland Flagship Fund. Okay, so the answer is yes, you do. What is accredited? I'll give you the pushcart definition of what accredited is. And you have to be someone that either does one of two things, or has one of two things. Number one, you have a net worth of $1 million or more, not including your primary residence where you live. So $1 million net worth or more, not including your house. Okay? And that's the main house you live in. Primary residence. Or you have to have earned at least $200,000 or more in income over the last couple of years. Okay. I mean, those are like the broad strokes, but that's what you need to be to qualify as an accredited investor. The Securities and Exchange Commission has passed down laws that need to be followed, and the reason why you have to be accredited is those folks want to make sure that you are at least at some level of sophistication, so you know what you're getting into, you know the risks, you know what's at stake, you know you can make money or lose money. They feel that if you're not accredited, you may not be fully aware of all of the ramifications of investing and may make a mistake. And they don't want that. Now, really what they're saying is if you're not accredited, you may be a dummy and you may not know what you're doing. I mean, that's really what they're saying. If you're accredited, for some reason they think if you have a good net worth and a good income, you're a little smarter than the average bear and you know what you're getting into. So you do need to be accredited to be involved in the fund. Now, with some of our opportunities and some of our investments, you do not need to be accredited. Okay? So just because you may not be accredited is not a reason to say, well, I'm out of this whole thing altogether, I'm not going to do it. I would not do that, because we do have opportunities that come up from time to time where you don't have to be accredited. And their deals sometimes are just as good as the deals we've got in the fund. So, for our conversation right now, you do need to be accredited to be involved in the fund. Okay? All right. This next question comes from, I'm not going to pronounce this right, Jane Morowitz, I believe. And Jane wants to know, what kind of returns can I expect from the flagship fund? You're going to have a single-digit income return in the higher single digits. So from an income standpoint, in terms of how much money you're going to have coming to you in distributions, you're going to be in that higher single-digit percent range. 7, 8, 9% is what you're typically going to see. Okay, that's what I see happening over the next couple of years, probably over the next 3 to 4 years. And so income-wise, I believe that's what you're going to be seeing, in my opinion. Overall returns, we should be in the double-digit range. So what do I mean by overall? Overall, I'm counting our income plus our appreciation plus our equity buildup. At the end of the day, after all of those things are considered, what's my return? We should be in the double-digit range. Based on, and I'll talk more about this later probably, based on where I see apartment occupancy going, the demand for investors to own apartments, and the trends that I'm following, and these aren't just short-term, these are long-term trends, I think that's where we're going to be. Okay, now obviously there's never anything warranted or guaranteed or anything like that, obviously. We don't do that and we can't do that, but that's where I think things are going. And that's where I think we're going to be. Many of our properties, by the way, we've owned over 10 years. So we've got track record with the majority of our holdings, which is great. So we're not venturing into a new purchase and kind of hoping things might work out with our new purchase. And that's not to say we don't buy new properties and add new properties to our fund, because we do, but most of what we have, we've got track record with. Okay, so that's what I see in Jane in terms of where our returns are going to be. All right. All right. This next question This next question comes from Dennis Michelson, M-I-C-K, Mickelson maybe, Dennis Mickelson. And Dennis asks, how long is your holding periods, and am I considered an active owner in this? I'm an active property owner. Do I get the active property owner benefits, in parentheses? Dennis, good question. Our window here is the next 5 to 7 years. So I think that when I look into, I'll just call it the crystal ball of real estate in terms of apartments especially, I think you're looking at a window of about 5 to 7 years here. And that's not to say that before then or after that you're still not going to have good appreciation and good income, but I see with our holdings that's where we're going to be maxed out. So I think we get to our highest and greatest value by that time. I think we get to our highest and greatest income by that time. And when you're kind of at your highest and greatest, and when you're still making progress but you're just squeaking it out, that's about the time you look at probably selling. Okay? And I think that's what our window is. It could be 3 to 7 years, as a matter of fact. It could be 3 to 7 years. But I don't see it going past 7. I'd be surprised. I don't see it being less than 2. So, I mean, we're probably 3 to 7 years more than likely in terms of a holding period, in terms of how long you'd be involved as an investor in the fund. That's at least what I'm seeing in terms of when I look at things, when I look at the multifamily market, especially the apartments we have now and what we plan on adding to our portfolio. Okay, all right. Next question. This next question, Bill asks this next question, and this is the most frequently asked question that we get, that Bill has submitted to us. And it's a long email, but I'm just going to get to the question because it's what I've got highlighted here. Bill wants to know, how do I get my money out? In a nutshell, I mean, he's got a long email here, but what I took out of it is what I get, the question I get from most investors, which is the most frequently asked question, which is actually I get asked more than what are the returns going to be. That's number 2. But number 1 is, how do I get my money out? You get your money out in 3 ways, Bill. Way number 1 is we sell everything and we cash everything out, and you get your money after we sell everything. Right? Pretty easy to know that. That's number 1. Number 2, the company buys you out. Okay? The company buys you out. And I'll tell you how that would happen and why that would happen here in just a second. Number 3, an individual partner, one of our other partners, buys you out. Okay, I'll talk to you about how and why that would work. So, let's go over those 3 really quick, because it's good to spend a little bit of time on this because it's the most frequently asked question I get. Obviously, if we sell everything, you start getting your proceeds, and that's how you get out. So I won't go into that too deeply because I think it's pretty self-explanatory. Number 2, though, the company buying you out. Why would the company buy you out? Well, life happens, Murphy's Law happens, things come up. So let's say you get involved in this investment, you get involved with the flagship fund, and the plan is, I'm going to be there for the next 5 to 7 years. Okay. 2 years later, you have a life event happen. Heaven forbid, okay? Divorce, maybe a death in the family, something major has happened. For some reason you need money, okay? And you've got money in the fund. So you contact me, you say, hey Darin, you know, I really wanted to be in this for another 3 years, but my daughter's getting married and the wedding is unbelievable and I need the money to pay for this wedding, so I need to get out. I need to get out of the fund and I need my money to pay for this wedding. I'm just making that up, but I've heard it before. So the company would then look at how much your ownership interest is worth, how much your value is, and would look at buying you out. Okay, we'd be buying you out early because we haven't sold the assets yet, right? Because you're only 2 years into it, but the company would buy you out. Okay, so that's one way of getting out earlier than selling all of the assets. Then there's the third way, which I mentioned, is having another individual partner buy you out. So it kind of goes in order. So if we don't sell all the assets, then to be able to sell your interest, you contact the company, and usually the company will be in a position to buy you out. But let's just say for some reason the company chooses not to buy you out. Okay? And the company does have that choice, by the way. The company does not have to buy you out. The company can choose to buy you out or not. Here's a good example. Let's say our company has, I'll just say $2 million in cash sitting in the bank. But let's say your ownership interest is worth $4 million. Well, it's going to be kind of tough to empty all the bank accounts, and we're not still going to be able to buy you out. But another partner may be able to buy you out, though. So what we do is we contact all the partners, and we say, Jim Smith, he wants to be bought out. His ownership interest is worth $4 million. Does anyone want to buy out Jim Smith? Okay, and we go ahead and we start getting into contact with all those partners that raise their hand and say, yeah, I'd be interested in buying out Jim. How much does Jim want? And we'd say, well, Jim's interest is worth $4 million. Okay, I want to pay $4 million. Wait a minute, I want to pay $4,100,000. Wait a minute, so all that's how it goes. Okay, well, another partner would step up and buy you out. And so those are the three ways that you can look at getting bought out. One way, again, just for quick review, is you get bought out when we sell everything. If you need to get out of the fund or want to get out or need to redeem your shares before all the assets are sold, then either the company will buy you out or we would have one of the partners look at buying you out. Okay, those are the ways that you would get your money back out of the fund, either if we sell or prior to us selling all our assets. Again, that's the most frequently asked question that we get. And oh, active owner. I didn't cover that, did I? Let me cover active owner, because that was from our last question, wasn't it? So that's how you get your money out. And as far as active owner is concerned, you are, once you're in the fund, you're considered an active owner of all the properties. So you get all the benefits of, as if you were running, landlording, managing your own apartments, your own apartment portfolio. So you get all of the benefits of that. So you get all of the income, all of the tax savings, all of the appreciation, all the principal reduction, all of the depreciation, all of the interest write-offs. So all those tax deductions that can bring your net income down considerably, you get. So let me give you an example of what happens. You may have a positive income from the fund, let's say of $10,000. Okay, so over a year's period of time, you get $10,000 worth of distributions. But because you're considered an active owner, and then when you file your income tax return, you can show a $2,000 or $3,000 loss legally. Well, Darin, how does that happen? How does that work? Well, remember, as an active owner, you get to count depreciation and you get to count interest as an expense. Okay? So when you get to do that, all of a sudden, a positive cash flow property on a tax return is going to look like a negative cash flow property, which you can now show a legal investment loss. Okay? So literally, you can make money, income, appreciation, equity buildup, but show a tax loss on your tax return, legally. Okay? This is nothing new, and this is nothing out of the ordinary. Most of our partners get to do this. So that's a good thing. Unlike if you compare it to like a real estate investment trust. You're just buying stock in a company that owns real estate. You don't get any of those active owner benefits. Whereas our fund, you get all the active owner benefits, just like you're nose to nose, toes to toes, doing it all yourself. And that's great. And that's the way it should be, frankly. So yeah, you get all those active owner benefits. Now, of course, every year we pay less and less interest on our loans, and we pay more principal down. So that means our tax savings, we lose a little bit of tax savings year after year. So I'm in no way saying that every year you get to show a tax loss, because you don't. But in the beginning, you usually can show those nice losses, even while collecting a nice positive income in increasing your net worth and your equity buildup in the properties. It's actually pretty cool. And it's one of the best ways to build wealth, because you really have 4 investments working for you at the same time if you think about it. You got income, you got appreciation, you got principal reduction on loans. So when those loan payments are being made, the tenants are making those payments, not us. So those loan balances go down every single month. Equity builds, and then the 4th is tax savings. You got 4 investments working for you at one time. There really is no other investment that does that. I mean, really. So it's fantastic, and you get all those benefits by being part of the fund. Okay? And then the last question is from Perry Valdez. Perry Valdez, hi Perry, and it is, why should I invest in the flagship fund versus investing with other people, real estate investment trusts, and he mentions a couple of folks out there that he's looked into in terms of investing and placing his money with them. Well folks, let me tell you, I don't compete with people, so I don't make charts and graphs of us versus this person or that fund or this real estate trust, or what they do here or what he does there, or what the guy flying the jet does versus what the real estate folks in Florida do. I don't do any of that. Okay. The reason why people get involved with us, I mean, there's really 3 reasons. One, of course, is they want to make money, and they want to own real estate without doing any of the management work whatsoever. So they want to make money, they want a good return on their money, they want great tax savings, and they want to be able to get all the active owner benefits of investment real estate properties without having any management responsibilities. Okay, that's number 1. Number 2, after that, they want to have a predictable property that gives them predictable results. And so in no way am I saying that we can predict what our properties do. You can't, realistically. But you compare Heartland of America and what we have here to big cities, and not in no way am I putting down big cities in America. God, I love them. I love going there, I love being there, and love being a part of it. But when it comes to predictability, here in the Heartland, things are pretty darn predictable. Things move at a slower pace. There's a lot more of a nostalgic connection here, and things are done more laid back than other large cities on the East Coast and the West Coast that I could name, and even in the southern parts and southeastern parts of the United States. So put it this way, in the real estate crash of 2005 through 2010, you didn't see much in the way of any effects here in the Heartland, especially with our apartments. So our apartments continued to run great, run predictably, and continue to give our partners a good return, even during the crash. Okay? Why is that? It's because of where they're located. It has to do with being in a conservative real estate market. Okay? Here's the bad news of it, by the way. We don't get giant upswings in property value. So your $50,000 investment that I talked about before is not going to be worth $150,000 in 2 years. Not going to happen. It's not. Will it grow? Yes. Will you make money? Heck yes. Will you get a good return? In my opinion, no doubt about it. But are you going to be jumping up in rocket speeds on stuff? No, you're not. On the other hand, you're not going to see big downswings either. So is your $50,000 investment going to automatically be worth $25,000 in 2 years because of some ripple effect in the marketplace here in the Heartland? No. Right? So you got to take the good with the bad, the yin with the yang, you know, pretty much that. And that's what a lot of people want. A lot of people want to know that they don't have to be laying awake at night worrying what's going to be happening here in the Heartland. Because you pretty much know what's going to be happening here in the Heartland. It's pretty boring. But remember this. Remember this, and this is so important that a lot of people don't get this. Boring is profitable. Okay? Boring is profitable. And then there's number 3, and that has to do with trust. So being involved with me, we do our best here to be as transparent and above board as possible. So I'll give you a quick example. I talked to one of our investment partners a couple of hours ago. He lives in Colorado, and he told me he was following me for over 15 years, decided to invest with us, I want to say about 5 to 7 years ago, roughly. But followed me about almost 10 years before that. And so he's been an investor with us now for the last 5 or 7 years. And he said to me on the phone, he said, Darin, the thing I most like about what you do and how you do it is everything is above board and transparent. So when you call the offices here and you want to talk to me, you can talk to me. You're not talking to one of my 5 assistants that I've got to intercept your phone call. If you want to come and visit the properties, you want to really see that we own real estate and that we've got the kinds of properties that we have in our property catalog. You want to get nose to nose and toes to toes with the market. You want to see what goes on here. Make arrangements. Send me an email. Let's get together. Let's take a look at stuff. You want to talk to our accountants and see what's going on. I'll set up the phone call. Talk to our accountants and talk to them and ask them questions if you want. You want to get into our property management. You want to see what that... So it's all there. There's nothing going on behind the scenes that we don't, we don't want you to know. And there are times when there's bad news. So we do have properties some months that don't do well. We do have occupancy or vacancy issues sometimes that we're disappointed in. Every property we've got does not operate and go up in value and crank out unbelievable cash flow year after year. Sometimes we've got to do improvements. Sometimes we've got to make some tenant changes. I mean, things happen like that. But bottom line is, whether it's good news or it's bad news, our investors know where we're at all the time. And that's really, at the end of the day, what most people want to know, right? So those are the 3 main reasons people get involved with us. And we've got over 200 investors that have been with us now for many years that they're happy that they did. And so, again, I don't compare myself to other people, other companies, and I don't even spend time looking at what they do and how they do it. I don't study them and say, geez, should we do what they do? I'm not copying anybody. That's typically how, as a buddy of mine says, that's how we roll, and that's how we do things. Okay. So I've covered the top 7 questions that I get from investors on the flagship fund. And hopefully this discussion has helped you and given you some information that you can use and think about and help you make a decision in being involved with us. And again, we do have a, when is our property tour coming up? Oh geez, our property tour, we've got a property tour tomorrow, this weekend, and we've got one more I think coming up in October. I just don't have the date, but that date will be coming up. So to get a look at what we're doing and how we're doing it, you can come here and take a look at what we're up to just get a hold of our, get in touch with our offices and we will get that set up. Okay? Hey, thanks for joining me today on this little different version of our podcast this week. But with everything going on, with our fund wrapping up here in a couple of weeks, we want to make sure we don't leave anybody behind. We want to give you the opportunity to get involved in it and make sure we get those top 7 or 8 questions answered as well. All right? Take care, everybody. Have a great day and have a great week or weekend whenever you're checking us out. We will talk to you soon. All right, take care. Bye-bye. See you later.
Thanks for joining Darin Garman's Paranoid Banker Podcast. For investment questions, comments, or to get in touch with Darin, go to www.garmanblog.com. Thanks for joining Darin Garman's Paranoid Banker Podcast. For investment questions, comments, or to get in touch with Darin, go to www.garmanblog.com.